In late February 2025, the Shanghai Futures Exchange implemented a delivery allocation policy that restricts accounts without hedging quotas from receiving physical silver. Within the same period, silver prices moved approximately 8% within a 12-hour window, and a persistent price differential emerged between Western and Eastern markets. These developments, combined with reported vault movements and exchange enforcement actions, indicate structural stress in the physical silver market. This analysis examines the mechanisms behind these events, the conditions that enabled them, and the range of outcomes that different market participants may face, depending on how supply and demand dynamics evolve. The analysis will proceed in 4 parts. First, the confirmed facts regarding exchange policies, price movements, and vault data. Second, the structural context explaining how physical metal markets differ from paper contracts. Third, the mechanics of delivery constraints and regional price divergence. Fourth, scenario mapping based on different paths for inventory levels, industrial demand, and regulatory responses. The Shanghai Futures Exchange announced that accounts without hedging credentials would receive zero allocation for silver delivery starting at the end of February 2025. This policy change represents a departure from previous allocation methods. The exchange also suspended 20 account groups within a single week, a level of enforcement activity that suggests concerns about delivery capacity or compliance with existing inventory management rules. Silver prices moved from approximately $78-$79 per ounce to $85-$86 in Western markets within a 12-hour period in late February. Market capitalization increased by an estimated $297 billion during this movement. The speed of the price change exceeded typical volatility patterns observed in precious metals markets. A price gap of approximately $7 per ounce emerged between Western markets and Shanghai, where silver traded above $92 per ounce. This premium persisted despite the theoretical opportunity for arbitrage, which would normally compress such differentials rapidly. COMEX reported 861,000 ounces leaving registered vaults in a single day. Delivery contracts were rolled forward at elevated rates compared to historical patterns. Open interest stood near 340 million ounces, while registered inventory in COMEX vaults was approximately 101 million ounces, creating a ratio of roughly 4.1 between paper claims and available registered metal. Bloomberg coverage acknowledged rising supply constraints during seasonal demand periods. Lease rates for borrowing physical silver increased across multiple markets. Analysts reported vault depletion patterns extending beyond New York and London to other regional storage facilities. China reduced silver imports from the United States while maintaining or increasing domestic accumulation of strategic metals. The Shanghai Premium reflects regional demand patterns that prioritize physical ownership over paper exposure. Silver serves dual functions. It operates as a monetary metal with store of value characteristics similar to gold. Simultaneously, it functions as an industrial commodity consumed in manufacturing processes, including solar panels, electric vehicle components, and semiconductor production. Unlike gold, which is largely recycled and remains in circulation, industrial silver is often consumed permanently in applications where recovery is economically unviable. To understand the current market structure, it is necessary to examine how physical metal markets operate relative to paper derivatives. In commodity markets, paper contracts represent claims on future delivery of physical goods. These contracts serve multiple functions including price discovery, hedging for producers and consumers, and speculative positioning. As long as most contract holders settle in cash rather than demanding physical delivery, the system functions smoothly even when paper claims exceed available inventory. Physical delivery markets operate under different constraints. Exchanges maintain registered inventory available for delivery against futures contracts. When contract holders exercise their right to take delivery, metal must be allocated from registered stocks. If delivery requests exceed available registered inventory, exchanges face operational stress. Responses may include raising margin requirements, implementing position limits, adjusting delivery terms, or restricting participation. The Shanghai policy change restricts delivery access to accounts with hedging credentials. This categorization distinguishes commercial entities with legitimate business need for physical metal from speculative accounts seeking delivery for other purposes. By limiting delivery to hedgers, the exchange reduces the number of accounts competing for available inventory. The enforcement actions against 20 account groups suggest the exchange identified behavior it considered problematic. Possible violations include exceeding position limits, failing to meet margin requirements, or attempting to manipulate delivery processes. The concentration of suspensions within a short period indicates coordinated enforcement rather than routine compliance monitoring. The price premium in Shanghai relative to Western markets indicates regional supply tightness. Several factors contribute to this divergence. China operates capital controls that restrict the free flow of funds across borders. Moving physical silver from Western vaults to Shanghai involves logistics, including transportation, insurance, customs clearance, and storage costs. These costs typically range from 1 tier 3 per ounce under normal conditions. A $7 premium exceeds normal transportation costs by a significant margin. This suggests either logistical bottlenecks preventing metal movement, inventory scarcity in Shanghai, making local buyers willing to pay premium prices, or regulatory barriers limiting cross-border arbitrage. The persistence of the premium indicates these constraints have not been resolved through market adjustments. Arbitrage normally compresses price differentials. Traders would buy silver in Western markets at $85, ship it to Shanghai, and sell at $92, capturing the spread minus costs. If this process functioned freely, increased Western buying and Shanghai selling would narrow the gap. The continued premium implies obstacles to this arbitrage mechanism. Possible obstacles include Chinese import restrictions or quotas limiting how much silver can enter the country, Western export controls or licensing requirements delaying shipments, insufficient vault capacity in Shanghai to receive and store incoming metal, or documentation and compliance requirements that slow the arbitrage process. The COMEX vault movement of 861,000 ounces from registered to eligible category or out of the system entirely reduces the inventory available for delivery. Registered inventory represents metal warranted for delivery against futures contracts. Eligible inventory consists of metal stored in approved vaults, but not currently available for delivery. When metal moves from registered to eligible status, it cannot be used to settle contracts unless the owner chooses to re-register it. Elevated rollover rates for delivery contracts indicate participants are postponing delivery to later months rather than taking metal immediately. This behavior can result from several factors, including insufficient registered inventory in the current month, logistical constraints at delivery points, or contractual terms that make later delivery more economical. High rollover rates may also reflect participants extending positions while waiting for market conditions to change. The 4:1 ratio between open interest and registered inventory does not necessarily indicate immediate crisis. Many futures contract holders have no intention of taking delivery and will close positions before expiration. However, if an unusually large percentage of contract holders simultaneously demand delivery, the registered inventory may prove insufficient to satisfy all claims. Industrial demand for silver continues to grow due to electrification trends and renewable energy expansion. Solar panel installations increased globally, and each panel contains silver in photovoltaic cells. Electric vehicles use silver in battery systems and electrical components. AI infrastructure requires silver in high-performance semiconductors and data center cooling systems. These industrial applications permanently consume silver, removing it from the recyclable supply. Monetary demand adds a second pressure vector. During periods of currency uncertainty or financial system stress, some market participants increase precious metals holdings. Silver attracts monetary demand as a more affordable alternative to gold for smaller investors or institutional portfolios seeking diversification. The combination of industrial consumption and monetary demand creates competing claims on available supply. Industrial users require physical delivery to manufacture products. Monetary buyers may also prefer physical possession over paper claims, particularly if trust in financial institutions or contract settlement deteriorates. Supply responses to higher prices typically include increased mining production, recycling of existing silver from industrial scrap or jewelry, and release of inventory from private storage. However, these responses operate on different timescales. Mining production increases require exploration, permitting, and mine development spanning years. Recycling depends on the economic viability of recovery processes and the availability of scrap material. Private inventory holders release metal based on price expectations and opportunity cost calculations. The current situation reflects several converging factors. China's strategic metals accumulation policy prioritizes domestic control over key industrial inputs. The Shanghai delivery restrictions and enforcement actions indicate exchange concern about inventory adequacy. The Western price movement suggests increased buying pressure, possibly from industrial users securing supply or financial participants repositioning portfolios. The persistent Shanghai premium confirms regional supply tightness that arbitrage has not resolved. Multiple scenarios exist for how this situation may evolve depending on supply adjustments, demand patterns, and regulatory responses. Scenario A represents gradual normalization. In this scenario, higher prices incentivize increased mining output and recycling over the next 12 to 18 months. Industrial users adjust manufacturing processes to reduce silver content per unit where technically feasible. Some monetary buyers take profits at elevated price levels, releasing inventory back to the market. Shanghai implements more refined delivery management that allows qualified participants to access metal while maintaining orderly market function. The East-West price premium compresses as logistics adapt and arbitrage flows resume. Prices stabilize at a higher level than pre-2025, but below the peaks reached in February. Registered COMEX inventory rebuilds partially as some eligible inventory returns to registered status. Conditions required for Scenario A include no major new supply disruptions at mining operations, continued operation of international shipping and logistics networks, moderate rather than explosive growth in industrial demand, and stable monetary demand without panic buying behavior. Indicators to monitor include monthly mining production data, registered inventory levels at major exchanges, lease rate movements, and the East-West price differential. Scenario B involves extended supply tightness. In this scenario, industrial demand continues accelerating due to renewable energy mandates and electrification policies. Supply increases prove insufficient as mine development faces permitting delays or technical challenges. Monetary demand intensifies if broader financial market stress drives investors toward hard assets. Additional exchanges beyond Shanghai implement delivery restrictions or modify contract terms to manage limited inventory. The East-West premium remains elevated or widens further as regional imbalances persist. Some industrial users face procurement difficulties, potentially impacting manufacturing schedules. Lease rates remain elevated as physical borrowing becomes difficult. Prices reach new highs with increased volatility as participants scramble to secure supply. Conditions required for Scenario B include constrained mining output due to geological or regulatory factors, sustained high growth in solar and EV sectors, deterioration in broader financial market confidence, and limited effectiveness of demand-side adjustments. Indicators include flat or declining global mining output, falling registered inventories across multiple exchanges, widening basis between futures and spot prices, and increasing delivery failures or force majeure declarations. Scenario C involves demand destruction and price correction. In this scenario, sustained high prices trigger substantial demand reduction. Industrial users accelerate substitution efforts, replacing silver with alternative materials where possible. Solar panel manufacturers deploy thinner silver layers or alternative cell technologies. Economic slowdown reduces industrial production generally, decreasing metal demand across sectors. Monetary buyers reverse positions, selling into the rally. Central banks or governments release strategic stockpiles to moderate prices. Shanghai modifies policies after achieving desired inventory management objectives. New mining supply comes online from previously uneconomic deposits that became viable at higher prices. The price premium disappears as supply-demand balance shifts. Prices decline from February peaks, potentially sharply if liquidation accelerates. Conditions required for Scenario C include successful substitution in key industrial applications, broader economic slowdown reducing commodity demand, central bank or government intervention in metals markets, and rapid supply response from previously dormant projects. Indicators include declining industrial demand data, technological announcements regarding substitution, government policy statements about strategic reserves, and rapidly falling prices despite initially tight physical conditions. The implications vary significantly across different participants. Industrial users of silver face potential supply chain risk in Scenario B if physical availability becomes constrained. Companies may need to build larger inventories, accept higher input costs, or accelerate substitution programs. Financial institutions with significant derivatives exposure face operational challenges if delivery processes become disrupted or if physical shortages lead to basis explosions between paper and physical prices. Exchanges must balance market integrity with operational feasibility. Overly restrictive delivery terms may undermine confidence in contract settlement, while inadequate inventory management risks delivery failures. Regulatory authorities may intervene if they perceive threats to orderly market function or systemic risk. Investors holding paper claims on silver through ETFs or futures must assess counterparty risk and the possibility that physical delivery may become difficult or expensive if supply remains tight. Those holding physical metal face opportunity cost considerations regarding when or whether to liquidate at elevated prices versus maintaining positions. Mining companies benefit from higher prices in the near term, but face questions about sustainability and the risk of demand destruction if prices remain elevated long enough to accelerate substitution. What remains uncertain includes the actual pace of supply response from mining and recycling, the effectiveness and timeline of industrial substitution efforts, the trajectory of monetary demand which depends on unpredictable financial market conditions, and the specific policy responses that exchanges or governments may implement. Key variables to monitor include monthly registered inventory levels at COMEX, Shanghai, and LBMA, industrial production data for solar, EV, and semiconductor sectors, silver content per unit in manufactured goods, lease rates in physical markets, and the east-west price differential. Changes in these indicators will signal which scenario is unfolding. The current market structure demonstrates the difference between paper claims and physical delivery capacity. As long as most participants settle contracts financially rather than demanding metal, the system accommodates large numbers of paper contracts relative to physical inventory. When delivery demands rise, particularly if concentrated in time, the finite nature of physical inventory creates operational constraints. To summarize the confirmed elements, the Shanghai Futures Exchange implemented delivery restrictions for non-hedging accounts effective end of February 2025. Silver prices moved approximately 8% within 12 hours in late February. A $7 per ounce premium emerged between Western markets and Shanghai. COMEX registered inventory declined by 861,000 ounces in a single day. Open interest to registered inventory ratio stands near 4.1. Shanghai suspended 20 account groups in 1 week. Lease rates increased across multiple markets. What remains uncertain includes the total global inventory of silver when including unreported private holdings, the precise breakdown of demand between industrial and monetary sources, the timeline for potential supply increases from mining or recycling, the extent to which industrial users can substitute alternative materials, and how regulatory authorities or exchanges may adjust policies in response to continued tightness. The variables that matter most include the rate of new supply coming to market, the trajectory of industrial demand from key sectors, the persistence or resolution of regional price premiums, changes in registered inventory levels, and any policy interventions by exchanges or governments. This situation illustrates the interaction between derivative markets and physical commodity fundamentals. We will continue tracking confirmed developments in exchange policies, inventory levels, and price differentials across markets.